Hey there, and welcome to this explainer. I am absolutely thrilled to have you here today. Look, if you've ever felt completely baffled by the precious metals market, you are in the exact right place. Today, we're going to fix one of the most frustrating, repeating mistakes that almost every retail investor makes. We're going to cut right through the endless market noise and show you exactly how to analyze things on your own using one very specific, highly mathematical trick. So get comfortable and let's just dive right in. Okay, let's start by validating a really painful reality. We have to ask ourselves, why do we always seem to time the market perfectly wrong? You absolutely know the feeling. You sit there watching prices soar, you finally buy in out of pure FOMO, fear of missing out, and then almost immediately you panic when the prices start to drop. It honestly feels like the market is personally working against you, right? Like there's some guy behind a curtain just waiting for you to hit buy so he can instantly crash the price. But I promise you, it's not random, and you are definitely not alone in this cycle. Let's walk through this emotional trap step by step, because I'm pretty sure this story is going to sound incredibly familiar. Step 1, gold goes up, everyone is talking about it, so you buy it. Step 2, gold dips. You get stressed, you completely forget your long-term strategy, and you panic sell at a loss. Step 3, gold starts going back up, but now you're frustrated, so you look for the next big thing. You see silver hitting an all-time low, you buy it, and just as you do, silver crashes even further. You sell in defeat, only to watch it hit an all-time high months later. It is literally exhausting. But what if we could remove this emotion entirely? Section 1. The logical anchor. Introducing the gold-silver ratio. We're going to shift our focus right now away from our emotions and instead anchor ourselves to pure objective math. So what's our anchor? It's called the gold-silver ratio. Now, before we get into the weeds here, let me be perfectly clear. This tool doesn't magically predict the future. It's definitely not a crystal ball, but it is an incredibly precise gauge of current value. Simply put, you calculate it by taking the current price of gold and dividing it by the current price of silver. That resulting number tells us whether silver is historically cheap or historically expensive relative to gold. It's an absolutely essential benchmark for understanding exactly where these metals are in their cycle. Let's break down the simple math using some recent exact data to show you how this actually looks in practice. Let's say gold is trading at roughly 14,360 rupees for 10 grams. If you take that price and divide it by the proportional price of silver, you get your ratio. In this specific scenario, that ratio hits exactly 62.2. That's our magic number for this example. Now, let's think about what that 62.2 actually represents out in the physical world. I want you to take a second and really visualize this in your hands. A ratio of roughly 62 means that just 10 grams of gold holds the exact same market value as approximately 620 grams of silver. Picture that for a moment. A tiny little gold coin in one hand and a massive, heavy block of silver in the other. They're worth the exact same amount. This isn't predicting tomorrow's prices. It's telling you exactly how the market values these two metals against each other right this very second. Section 2. Decoding the numbers. The golden rules of metals. Now that we have our ratio, what do we actually do with it to stop losing money? Well, we can translate that single number into strict, actionable trading rules. When the ratio climbs above 80, it means gold has run far ahead, leaving silver in the dust. Silver is historically cheap and deeply undervalued here. Conversely, when the ratio drops below 50, silver has caught up and become highly expensive relative to gold. Historically, when the ratio hits this 40 to 50 danger zone, silver is at extreme risk of correcting, sometimes dropping by up to 60% from its peak. Section 3. History in action, proving the pattern. Of course, numbers are just theory until we back them up. And what's really fascinating here is how perfectly major historical events validate our rules. Look back at the COVID-19 crash. The ratio exploded to an incredible 125. Silver was screamingly cheap. And what happened next? Silver initiated a massive, strong rally to close that gap. On the flip side, examine April 2011. The ratio compressed all the way down to a tiny 30 to 35 range. Silver was highly, highly expensive. The outcome? A grueling multi-year correction in silver prices, while gold remained comparatively stable. But we don't even have to look back to 2011 to see this in action. Let's just trace the dramatic textbook market cycle of the last 12 months. In April 2025, the ratio was sitting at 100 plus. Silver was deeply cheap. Fast forward to January 2026, and silver had delivered a staggering 135 to 150% rally. Because of that huge spike, the ratio plummeted below 45, entering that expensive danger zone we talked about. By March 2026, the market corrected and the ratio normalized right back to that 63 to 66 range. It's a complete cycle playing out exactly by the numbers. And the brutal reality of that March 2026 fallout is just undeniable. When that ratio dropped below 45 in January, it was a glaring warning sign. And when the correction hit, it was heavy. Silver plummeted by roughly 45%. Gold, on the other hand, dropped only about 20%. This proves for sure that when the market corrects, silver crashes more than twice as hard as gold. Section 4, the final verdict, the true nature of metals. So now that we understand the math and we've seen the history, we need to completely reframe how we build our portfolios moving forward. The absolutely crucial point is this: you cannot treat gold and silver the same way. They are fundamentally different beasts. Gold is your stable, resilient foundation. It's the metal that holds its ground better during crashes, dropping significantly less. Silver, on the other hand, highly volatile. It's the metal that brings you those wild 135% rallies, but it also brings those steep, gut-wrenching 45% crashes. You just have to respect the unique nature of each asset. I really want to leave you with this final, vital piece of actionable wisdom from our analysis today. Ignore the short-term moves and focus purely on the signals. Remember how we started this explainer? The panic, the FOMO, the emotional trading, all of that is caused by getting distracted by short-term market noise. The noise will ruin your portfolio, but the math, the ratio, the historical signals, they will guide you safely through the cycle. Which brings us to the most important question of all. Take a look at your own investments right now. Grab a calculator, check the current prices, and do the math yourself. What is the gold-silver ratio telling you to do with your portfolio today? Are you sitting on an undervalued opportunity, or are you dangerously exposed to a costly correction? The numbers are there just waiting for you. Thank you so much for—
Disclaimer, this video for educational purposes only and not financial advice. Always do your own